Ópera apresenta Expogestão.
Good afternoon. First, I would like to thank Alonso for his hospitality and also to Marconi for taking such good care of me. My name is Andrew Romans. I'm a general partner of Rubicon Venture Capital, and I live in Silicon Valley in California, and I run our San Francisco office. We also have an office in New York City. So, very briefly on our business, we raise money from high net worth individuals, so wealthy accredited investors, from family offices and large corporations and some institutional investors, and we take that money together and we invest it in about 35 different startups where we typically buy a minority position in that company, and we try to help the company as much as possible. So my story is that I was an entrepreneur. By the time I was 26 years old, I had raised $15 million from VCs and another $25 million from Lucent Technologies. So I was originally a telecom entrepreneur. And so I had the experience of having venture capitalists invest in my startup and then be on my board of directors. And I found that some of these VCs were probably on too many startup board of directors to be effective. Some of them were even on like 10 or 20 startups where they have to go to the board of directors meeting and try to be effective. And so I then became an angel investor where I started investing into startups with my own personal money. And then I decided I wanted to raise my own VC fund and try and do it in a way that adds more value to the startup. So basically, our goal is to help the startup as much as possible. So for example, my real purpose of being in Brazil this week is to develop relationships with people that could potentially partner with some of our startups and help them grow in Brazil and Latin America. But briefly, I wrote a first book on venture capital, which has been coming out in Chinese and Russian. And the first book was getting too long, and I decided a second book would be about corporate venture capital. And it's actually a large Chinese telecom vendor asked me to advise them on setting up their CVC. So CVC is corporate venture capital. So this means large companies that have a corporate venturing or CVC practice, like Intel Capital or Microsoft Ventures or Citibank, these sorts of things. And what I did for this Chinese conglomerate is I said, okay, I will interview the top 20 corporate venture capital groups like Intel Capital and others, and Cisco and Qualcomm, and I'll ask them how they do everything. Do they have an investment committee? Does the CFO need to sign a piece of paper? Do you need a business unit to agree to do business with the startup before you guys invest money? How do you pay yourselves? Are you being compensated like a normal VC or not? And I said I'll interview the top 20 and I'll put a report together and show that to this Chinese large company and then give them advice on how they should specifically set up their CVC unit. I then decided to interview about 100 CVCs. So my normal job is investing in startups. And to be honest, I take a lot of meetings with other VCs for lunch or coffee and say, show me the startups you have invested in, and if I can help one of them, let me invest in that with you. So doing the research for this book was actually just doing my job. I met with 100 corporate venture capitalists, and I asked them all the same question: why do you do this? What are the main reasons why you even operate a CVC? And I took all the answers that they gave me, and I put that into chapter 1 of the book. So just briefly, this slide. This is the third book that I'm working on right now, which is really about how the startup should raise money. And even a good VC like me, I'll invest money in the startup, but then I introduce them to other VCs to get more money into these companies. So the number one cause of death for a startup is running out of cash. You either get cash from a customer or really investors. And so it's an incredibly important topic. So I'm going to talk a little bit about corporate venture capital, a little bit about how this could possibly be important here in Brazil, and then a little bit about what Rubicon Venture Capital's role is in the marketplace. But the big picture is that there's something in it for the corporate, there's something in it for the startup, and there's something in it for the financial, profit-driven venture capitalist like me. So I want to make money. I want to make a financial return, basically buy shares in the startup at a low price and sell it at a high price from an IPO or an M&A or even selling shares in the secondary market. For the corporations, there's a lot at risk. I would say the stakes are very high. If you're a large corporation and you have a corporate development group, meaning an M&A practice where you acquire and buy startups or buy other companies, you probably should have some kind of CVC. You probably could be investing into other VCs and then invest in some of the startups that you have a strategic fit with and use that to help you drive M&A. But it's actually quite a complicated topic of why the corporation should operate a CVC. And every corporation is unique and has different issues. So it's going to be different for every company, out there. But I think that right now, where we are in history, more than ever, I think we're entering like a new second industrial revolution. So we went from like farming agriculture by hand to using machines. And right now, we're writing software that sort of for the first time, the software is dynamic. The software can connect to the internet. So for example, if I were on a game show where they're asking me questions, and they say, what's the population of Eindhoven, Netherlands? And I hit the button, and I listen to an earpiece, and someone is on the internet finding the answer and telling me the answer. Software now is connected to the internet. It's connected to big data. It's connected to lots of sensors, and the software is learning from itself. If you look at China, China has benefited from an arbitrage opportunity of low-cost labor. A peasant that moves to the city and works in a factory in China makes less money than someone in Ohio in the middle of the United States. They also have the China Development Bank, but the arbitrage opportunity of low-cost labor in China is already moving to India and Vietnam. The American leadership, let's not even talk about Trumpistan, but he thinks we're going to turn Americans into Chinese peasants and build an iPhone factory 1 square meter bigger than the biggest one in Shenzhen. That is stupid. The Chinese leadership is very smart, and they're investing in venture capital funds to make robots that can think at least as well as a peasant and do the job in the factory with a machine and stop the factories from moving to India and Vietnam. And they want to keep the money flowing from Brazil, Sweden, USA into the current account of that country. So for China, they very specifically have a strategy of investing in venture capital, driving specific topics to re-engineer the entire economy from make cheap things that end up in my basement and yours, made in China, cheap door, cheap windows, cheap everything, to more of a Goldman Sachs, Apple computer economy. So they're transforming the economy, and they're doing it kind of one company at a time in a very centrally planned, organized manner. So I think that if you think about it, a lot of people, when they talk about venture capital at a conference like this, they're thinking, okay, we need to make a Silicon Valley here in Brazil. How can we get startups of our own and have our own unborn babies that'll conquer the world? That's true. I think that, your options are you can kind of take an Israeli model. Like Israel, the home market is so small that a startup in Tel Aviv is not going to be satisfied just selling to the domestic Israeli market. They're born global from day one, and they'll make technology, and they'll try to win the USA and take China to win the world. And they have a fairly robust, successful innovation machine. So Brazilian startups could go the Israeli model and say, we're going to make companies here, and we're going to invade the world and take over the world. A second one is we can make copycats. Brazil's a big market with a large population. We can make copycats. And a third model is to say, we're going to solve unique problems that are specific to Brazil, which is different than the United States or different from China. But a fourth point that many people do not talk about, which is perhaps the most important one, is let's talk about your big babies. Who are the top 50 companies in Brazil? Make a list. Who are the biggest conglomerates, the biggest family offices? And I would say Mark Andreessen is correct that software will eat the world and it will not spare any industry. All this dynamic software that can replace what a human does is happening for real. And humans will continue to find jobs and things to do. But if you look at a value chain of anything, like we invested in a company called Lenda that helps you get a mortgage for your house or refinance your mortgage. And they look at what every human does along the path, and they start writing software to do the job of the human, and it probably does it 10 times more effective than the human did. Basically, the big corporations of Brazil should be having some organized manner to access startup innovation and incorporate that into their business to make sure that they are a beneficiary of this sort of second industrial revolution and not a victim of getting disrupted by someone else. So for the corporations, the stakes are high. For the startup, the opportunity to partner with a large corporation is quite interesting. If I invest in a company in Silicon Valley and Marconi is introducing me to his network here in Brazil, and we can find companies that are willing to sell our products and services or become a customer and partner with us, that's good news for the startup. Normally, the Silicon Valley mentality is focus on San Francisco, then go to New York, maybe Chicago, and go to London because they speak English there. If you say, why don't we go down to Brazil or Indonesia, the answer is, that sounds like a waste of time and money, don't do it. I think in the modern world, you look at Uber, by the time they got to London, Didi was already beating the other 50 copycats of Uber in China. So I think we're living in a world where it's about speed to execution. How fast could Uber launch in China before Didi takes over? So the long-term vision for me and Rubicon Venture Capital is to populate, cover the globe with partners, whether it's an individual person, a family office, a large corporation, and institutional investors that want access to the technology and create these partnerships. And that's really the win-win-win. What I found in studying the corporate venture capitalists from the Japanese to the Middle Easterns to the Russians, the Chinese to the Americans is it's quite complicated. The way normal venture capital works is, let's say that you and I raise a $100 million fund and we're 50-50 partners. What we'll do is we'll charge an annual 2% management fee. So 2% of the entire $100 million, every year we draw that down. So we would have $2 million to pay for our office, hire some people, pay the accountants, lawyers, and a salary. And then we invest the remainder of the money. So basically we would have $80 million we invest, and $20 million is the the budget to run our business. After we invest the $80 million, we expect to exit and divest from these startups, from IPO, M&A, or even selling shares on the secondary private market. We return the first $100 million, so the 80 million plus the 20, we return all the paid-in capital back to our investors, and then there's an 80-20 split. So we get 20% of the profit on the fund. So it was nice that we paid ourselves $2 million a year along the way, the 2% annual management fee, but we really expect to basically raise the $100 million, invest it, and return something like $500 or $600 million back to our investors and keep 20% of that. So what I really want in this case is to make $100 million. When the corporations set up their corporate venture capital units, you typically have someone from the M&A department, corporate development, decides, I want to set up the CVC, and pretty fast, there's someone who's been with the company longer than that person saying, there's no way you're paying yourself $2 million salary, and there's no way we're going to let you make $100 million. I only make, the guy who's been there longer probably doesn't make even 500K. So the result is that the people that work at Intel Capital, the people that work at Salesforce Ventures and all of these corporate venture capital groups, they co-invest with VCs that make the 2 and 20 compensation, and yet they are not being paid the same way. So the result is that most of the people that work for a corporate venture capital firm in that business unit, they really only stay there for maybe 2 years before they quit and try and get a job. I jokingly say that they're like a slave on a plantation where they're shackled in chains, and they've got to get their CFO to sign every piece of paper. They got to get a business unit. They're being told to only invest in a couple of buzzword topics, which is myopic and probably wrong, and they're not getting paid. So the strong ones will leave and join a 2 and 20 type of VC, or they will just make a lateral move to another CVC where they get paid a higher salary. So ironically, the longer someone has stayed with the CVC unit, probably the weaker or the worse that individual is at it. The other thing that tends to happen is that a lot of corporations enter the CVC market at the top of the market when everything's getting frothy, and they cancel the program about 2 or 3 years later. So there's a few, like Intel Capital and Qualcomm, that have lasted for a long time and have good longevity, but often these things get canceled. And the problems get even more and more and more complex. Oftentimes, the head of M&A is the same person in charge of investing. That's how they do it at Cisco. That's how they do it at Qualcomm. And so imagine you are a startup and you're raising money to build your business, and you get a CVC invests in your company and joins the board of directors, and then that CVC decides, we want to acquire your business. And I'm on the board, and I'm thinking, well, they want to buy us, how much? They say maybe $100 million. And I'm like, okay, I think we should raise $10 or $20 million, grow sales, and make them pay more to buy this company. I'm a blood-sucking venture capitalist. That's what I would do. But if I have Intel Capital on the board, and this guy, his business card says Intel, it doesn't say Rubicon or the startup, it's a major conflict of interest. So oftentimes, the CVC might even become a customer and give revenue to the company. We're dual tracking to sell it or raise money at the same time, and then they pull the revenue out from underneath us, collapse our ability to raise capital, and buy the company on the cheap. So a lot of financial VCs hate CVCs and will never, ever take money from a CVC. For example, I like to pick on Verizon Wireless Ventures. Why call yourself Verizon Wireless Ventures? It's the stupidest name ever for a VC fund. If Verizon wants to invest in one of my companies, then the minute we take money from them, we've shut the door to getting Sprint, AT&T Wireless, or T-Mobile as customers, we've shut the door to selling our business to one of their competitors. So the better thing to do would be have Verizon invest in the company and keep it a secret, and then help the company get distribution into their stores or on their phones and do major business with Verizon, but don't ever tell the other ones that you did it. When I was 26, I raised the $25 million from Lucent, from Rich McGinn, and immediately John Chambers at Cisco stopped talking to me. It was an irreversible action. I could never turn it back. Once I got married to Lucent, it was game over for me with Nortel, Siemens, and Cisco. I chose my side. You can only be in one tent with these guys. So the big vision is that if Verizon keeps calling itself Verizon Wireless Ventures, and they do, they will not get access to invest in my companies. Whenever we're fundraising, I showed you I'm working on that new book about how to raise capital. It's where I spend most of my time, helping our companies raise money from value-added investors. And we make a list on Google Docs that say these are the first 20 VCs we're going to introduce this startup to. And if we don't successfully raise money from them, we're going to go to our tier 2 list. It's kind of like I'm going to try to get into the MBA program of Harvard or Stanford or Wharton. And if I can't get into that, then I'll go to this one. And if I can't get into that, I'll go to Alabama State. So like Alabama State is the bottom, Stanford is the top. When we don't even put Verizon Wireless Ventures on our first, second, or third list. So basically, they don't get to see anything. So if you go back to why is a $100 billion company bothering to have a CVC program? It's probably not that they're going to invest money and make a 5x return on it, and it's going to influence earnings per share or the market capitalization of the company. They're looking for access to that industrial revolution, dynamic software technology. There's offense and defensive reasons they're doing it. But they've alienated the top 95% of the deals by calling themselves Verizon Wireless Ventures, and people are worried that they're going to cancel the program, and when the company goes to raise another financing round, they'll be orphaned from their existing investor, and if they don't cancel the program, it's likely that the individual investment professional made a run for it and got off the plantation and no longer works there. So if you do raise money from CVCs, you should be careful. If they want a board seat, I say, okay, give them a board seat, but now have 2 sets of board meetings, one with them and one without them. Remember, they're probably more interested in buying your company or buying your competitor than they are in making a financial return from you. So we do not trust CVCs. We consider them like a wolf running around, trying to grab our wallets. Now, at the same time, we want to do business with them. For me, it would be a fantasy if I could get, say, 20 mobile network operators like Telefonica and Turkcell and Zain across Africa to all invest in my fund. And if one of you has some mobile payment system, I could put it on 10,000 phones in Africa, and if that works, 100,000, and if that works, 1 billion people, and we can IPO that company on a profitable discounted cash flow based on our partnership with those corporates. So it's funny. On the one hand, it's like the holy grail opportunity for a startup to work with these big corporations. And on the other hand, it's extremely complex and dangerous. So my advice to the corporation is take a look at the reasons why other CVCs do it. Sometimes it's like, well, if everyone else has a CVC, maybe we should also. About 20% of all venture financings in the United States have at least one CVC participating in the syndicate. So that's a lot. You cannot ignore this. It's 1 out of 5, and it's probably increasing right now. But what is the most sensible strategy for the corporation? I say that everyone is different. Some of these companies from Southeast Asia that I've met with have like $4 billion of EBITDA profit a year, and they don't know what to do with the money. So they basically have an M&A team trying to vertically and horizontally integrate, and they're buying companies. For them, if they create a CVC, it'll help them on their human resources decide who we should even be hiring. Like, should we be hiring voice recognition, machine learning, big data, whatever buzzword you want? They can help them understand organically who to hire, and they can help the M&A department decide who to acquire. If they have revenue from Brazil, they might have difficulty getting the money out without paying a lot of tax. It might make sense to create a venture capital fund in Brazil and use your Brazil profits, to enter that market. So I think that if they make their list and they recognize that they're unique, like Time Magazine in New York City has 70 print publications. If they don't adapt their business, they will die. That company's going to go bankrupt unless they change very fast and get onto mobile phones somehow. So for them, their list of objectives is don't die. For other companies like the Southeast Asian conglomerates, they've got so much cash, it's more about who do we buy? Let's use CVC to juice M&A. But then recognize that for a lot of these guys, you've alienated all the best deal flow. So Frederick Rambaud is a friend of mine. He ran Qualcomm Ventures Europe, and then he ran Cisco. And he invested in 2 VC funds here, actually. I know Redpoint eVentures was one, and there was another one. But what he did, I think, is the smart thing. He basically invested in 57 VC funds first. So Cisco had about half of its revenue coming from Europe, and they didn't employ anybody there. It was just the salespeople that they had. So they hired Frederick. He invested in 57 VC funds across Europe, and then he got to see all the portfolio companies that those VCs invested in. So he let the VCs do all the work. They go through their fund of all the deals they look at, which ones they do their due diligence, and then they make their investments. Frederick was just cherry-picking the best deals out of the portfolios of the VCs that he invested in, and started trying to find business units within Cisco to partner with some of those startups. And if he could get that fit, he would make a direct investment. So he used fund of funds as step one to get into the business. It's almost like bribing the right people in US Congress or Russia. Buy your way in and come in at the top of the food chain, invest in a bunch of VC funds, but only if they're going to share information with you. If they're not going to share information with you, what's the point of $100 billion Verizon investing in Sequoia to make a little return? They need to have access to the business intelligence and the direct investing opportunity for Verizon to put some money in and partner, and ultimately share that information with corporate development, M&A. So I think it's step one, fund of funds. Invest into VC funds, but only if they share information with you. And step two, cherry pick and invest in those best deals. This is sort of the way we operate. I mean, when I did the 100 interviews for this book, I was just meeting VCs and them showing me their portfolio and me trying to pick the best one to get Rubicon money into. So it's not that different. So on the Brazilian side, I kind of already talked about it, that your options are make transformational companies like Israel, where these companies will not be satisfied to just only being in Brazil. They'll go global. Or you can do the copycats, or you can make startups that solve your unique problems. But the big thing is, I think we should recognize the importance of a highly evolved ecosystem. Like in Europe, you pretty much have SAP. It's like the only publicly traded tech company. 82% of all European venture-backed startups get acquired by American domiciled buyers. So 82% of every IT company in Europe is going to have an American master. That's pretty crazy. If that statistic remains static for the next 30 years, what does that mean for French society or Britain or Germany? I think that they suffer from not having growth capital, and they suffer from not having acquisitive local businesses. So probably the answer for Europe is to not just have seed stage venture capital, but to have growth stage capital, write that $60 million check to get the company to go public on the stock exchange, and then you'll have more than just SAP. But the big thing is that it doesn't surprise me to hear 82% of all these venture-backed startups get acquired by American buyers, because within about 20 minutes of where I live in Silicon Valley, you've got Google, you've got Oracle, you've got Facebook, you have Hewlett-Packard, you've got Adobe. Drive a little bit north, you've got Amazon and Microsoft. So there's a lot there. This ecosystem is not going to get rebuilt anywhere else in our lifetime. But I think corporate venture capital can help a country like Brazil leapfrog and move faster to create an innovation economy and transform, kind of like China going from making cheap stuff in a factory to being innovative. So I think that I make the analogy to Los Angeles. There's like what, the big 6 movie studios are all in Burbank, California. They're all in Los Angeles. The hot, beautiful girl from anywhere moves to LA to get into the movie business and TV. Hollywood is not about to move to Chicago. I don't care if the mayor of Chicago wants it to, it's never going to happen. Never going to happen in our lifetime. Right now, the amount of critical mass of big balance sheet tech companies in Silicon Valley that will buy a startup is sort of unstoppable. Whenever they buy a company, a bunch of 20-year-olds all of a sudden get rich overnight, and they stay for the good weather. And what are they going to do? They're going to invest in startups of their friends. This is what I did. And so the ecosystem there is incredibly evolved. If I just go with my kids to soccer practice, I'm going to meet the guys from Redpoint sitting on the side of the field, and I'll meet Google Corp Dev. So without trying, you bump into people. So here's the takeaway. I don't want to be a rude American and say that Silicon Valley is great. It's got its problems. But the point is this. If you've got a startup in Brazil, or if you have a large corporation in Brazil, a conglomerate, family office, any of these businesses, you should have direct access to the #1 ecosystem, which is Silicon Valley. You should have direct access to the #2 ecosystem, which is New York City, and direct access to London, which is the #3. So I think the solution is don't be isolated. And I make the effort to come down here, and you should make the effort to visit me in Silicon Valley and New York. And Frederick Rambaud's model might work for you. Invest in some VC funds and invest in funds that want to partner with you. And we'll have a free flow of technology, and you'll benefit from that system. So this slide just kind of shows the basic model of Rubicon Venture Capital, where we're not afraid to take a small check off of a cool person from another ecosystem, because that person has their own trusted network that over time will lead to more and more and more. It's important for me that my book has been translated and published in Chinese and Japanese, because those are very important markets for us. So we're raising money from lots of Japanese corporations and a number of Chinese corporations. We would like to be able to differentiate ourselves from other VCs. When I'm fighting to get into the hottest deal in New York or London or Silicon Valley, I need some sort of differentiator pitch. If I can say that I've got friends in Brazil that I already spoke to last night, and they're ready to partner with this startup, then we should be able to beat out Sequoia or Kleiner Perkins or any other VC, and we're the value-added VC. That's what I started at. As the entrepreneur, I want a VC that's going to help me, not just with cash, but help me solve all my problems. And revenue is always a good one. So the ultimate vision for Rubicon Venture Capital is to create something like a multi-CVC. We'll involve the operators, the angel investors. We'll involve the multifamily offices from Turkey, from Africa, from China, from Singapore, from Malaysia, from Indonesia, all these places, and help our companies get faster. So if we had invested in Uber, we would have been in China bigger than Didi, with government advantage blocking the IP address of Didi, like it was WeChat killing WhatsApp. So that's the long-term vision. Yeah, so the Japanese really pushed a lot of our thinking on how we've set up our fund. One thing we do is we rotate executives from the corporation to work in our office. So a Japanese corporation can give us a limited partner in residence. So they spend 12 months with us, either in our San Francisco or New York office, and after 12 months, we kick them out and we send them back, and then they send us a new one. One of the problems that the Japanese were saying to me is that they make the analogy to American baseball. There's too many pitchers and not enough catchers. So the Japanese send over Japanese people, actually. It's probably a mistake. And they are based in Silicon Valley, and they invest in startups. And then they throw the idea back to headquarters in Japan, where people are working. It just lands on the floor, and nobody wants to touch it. So there's resistance from the business units to even doing business with a startup. In Japan, you make one mistake and your life is over. So what we're thinking is rotate executives through our office, and when we send them back, it's like a double agent. So it's like KGB, CIA. We brainwash that person, and they know how we operate, and we have someone to try and get a partnership going, with the startup. So that's the big opportunity. Corporate venture capital is probably a good way to jumpstart certain ecosystems, potentially like Brazil. I've never been to Brazil before, so I consider that I know nothing, and I'm just trying to learn a little bit this week, hanging out with you guys. But I would think that if the large corporations that are sitting on a lot of cash were to invest in local funds that get access to all the deal flow locally and get access to the technology happening in the larger, more evolved ecosystems like London, New York, and Silicon Valley, it can be very good to ensure that these large corporations do not go bankrupt and they benefit from all this technology that's changing everything so quickly. And it'll help create a population of entrepreneurs here that can take over the world, kind of like Israel. I mean, you guys have clear advantages of a huge population and a great business culture. I think I was saying to Marconi last night, I don't think that the big resources here are underground or your population. It's the Brazilian personalities. They're pretty amazing. I think that you guys will be successful anywhere. I mean, we've taken a model to always invest with the top elite other investors, and oftentimes we come in after them and we say, we're going to add value, let us put some money in there. And oftentimes we invest first, and we introduce our companies to these guys. I think that your statistical probability of getting lucky increase when you're co-investing with like the top name investors. So rather than just write the book and leave it in like academia, we've been traveling around the world doing half-day seminars where we get really deep in the topic of corporate venture capital. And we're going to do that Monday, May 15th, in Sao Paulo. So if you're interested, if you work in corporate development or M&A at a large corporation, or if you have a CVC already, or if you're thinking about one, or if you run a big family office, it might be worth coming up to Sao Paulo and spending a day with us. Or meet us in London, or Paris, or San Francisco, or Istanbul, or Beijing, or Osaka, or Tokyo, where we're doing this all over the world. And so this is part of the vision to sort of share the learnings of the book, but we do it in a real roundtable where I'm learning as much as they are and taking it into the real world. We also do evening events that are designed for the entire ecosystem. Startups, angels, VCs, corps, lawyers, service providers, everybody. And we're doing that at Monday night in Sao Paulo. If you go to rubicon.vc and click on events, you can see the links to it. And email me and I'll give you a free code. So if you're friends with us, you shouldn't pay. And if we don't know you, you can pay and then we'll buy drinks afterwards. So, and my email address is andrew@rubicon.vc. I'd be happy to hear from you. So 10 seconds, right on time. Thank you.
Ópera apresenta Expogestão.